Hey folks, welcome back to another episode of Malcolm on Money, where we decode some of the more complex financial topics people tend to run into in an attempt to simplify it and make it as plain as possible. Today, we're going to be digging into what happens when you own a substantial amount of company stock inside your 401k plan and how you can potentially save yourself a good deal on taxes by utilizing a strategy known as net unrealized appreciation. Since a lot of companies have gotten creative over the past couple decades about how they compensate and motivate their employees, one of the more popular practices is to offer those employees opportunities to own company stock inside of the 401k plan. And depending on how long you happen to stay at that one employer, in some instances, it is possible for folks to accumulate a pretty sizable lot of shares. And since you're owning them inside a tax deferred account, the taxes on any growth you see in those shares is literally deferred until some future date, but not necessarily at your retirement. What happens to those shares if you decide it's time to part ways and you're only 50? Or let's say you're at retirement age, you're 65, you decide it's time to clock out for the last time. Typically, when employees leave a company where they've contributed to a retirement plan, it's customary to simply roll that 401k balance into either their new company's plan or into an individual retirement account. There's a handful of good reasons to do this, but one reason to do it is just that rolling over the 401k money provides you a great way to continue deferring taxes on the account's earnings until you begin taking distributions. And before making any moves at all, it's important to make sure that you know what you want to do with those dollars before you've submitted the paperwork and requested that rollover, because there is no going back. You can't plead ignorance on this one, which means that once the toothpaste is out of the tube, it's out. If you do own a significant amount of shares of your company stock inside the form, well, the word significant is subjective. So I do want to make sure that I make it clear, for the sake of easy math, let's say you own something like $500,000 in your 401k plan. That's your overall balance. And 20% of that amount is in company stock. So let's say $100,000 is what's the amount in question, right? If the stock you own inside the former company's plan has appreciated any, it's not a straightforward decision of whether to roll those dollars over into the new company's plan or even into an IRA. It's likely that you're prohibited from rolling that appreciated company stock into your new company's plan anyway. It could also be prohibited from rolling into the IRA, depending on who your custodian is. But a change in employment could provide you with an opportunity to move the stock to a brokerage account. You'd immediately pay the applicable taxes due and subsequently receive a much more favorable tax treatment on any gains in that stock in the long run. There's also an opportunity for an estate planning technique that would save your heirs quite a few dollars down the road, but I'll get into that one a little bit later. So the difference between the stock's value when you acquired it, when you bought those shares in the plan, and its current value is what's known as its net unrealized appreciation. That's what's going to be subject to capital gains tax rather than the more costly ordinary income tax by executing an NUA transaction rather than doing a direct rollover. That's why moving the company's stock to a brokerage account as opposed to rolling it into another tax deferred retirement account could be the preferred option. In other words, let me make this one plain a little bit here. The way the appreciation in the stock's value is ultimately taxed is going to depend on the type of account the stock is transferred out to when you leave that company and that money leaves that 401k. So if the transfer is to an IRA, the full account balance is going to remain deferred from taxes until you take a distribution. Nothing wrong with that, right? Tax deferral is certainly helpful, but it's important to be aware of the inherent trade-off that you're ultimately making, right? In that instance, you'll have to pay ordinary income tax on the stock's full appreciated value once you sell it or take a distribution in the future. And even if your plan is to sell those appreciated shares immediately after separating from the employer, let's say maybe you just want to diversify away from that position, maybe you need to use the cash to do something, there's still an advantage to rolling those shares to a brokerage account first, because as of the time of this video, I say that way because tax rates are always subject to change. Who knows what Congress will do tomorrow, and who knows when you'll actually watch this video. But as of today, stocks are required to be held for just 1 year to receive long-term capital gains treatment rather than ordinary income tax treatment, right? But that's not the case with stock transferred directly from your 401k to a brokerage account. So to make it a little bit more clear, let's say there's a person named Elizabeth, and Elizabeth is an employee at Apple. She's been at Apple for 20 years. She's planning to leave at the end of the month to take a new role at a competitor, and she's accumulated $500,000 worth of Apple stock inside her 401k plan, which is mostly due to long-term appreciation. I say that way because, for a person who works at Apple, for example, it is very likely, very possible that over the last 20 years, that stock has appreciated tremendously just based on what Apple's share price has done, right? So that's a great example of how this could work. So let's say Elizabeth's basis in the stock is only $50,000. So we got a $500,000 market value, $50,000 basis. Obviously, we've got a $450,000 delta in there. If Elizabeth is going to roll her entire 401k balance, including the shares of Apple, into either a traditional IRA or her new company's 401k plan, her entire position is going to be liquidated and she'll receive a cash deposit into the new account. Then when she retires, she's going to pay ordinary income taxes on any portion of her tax deferred retirement account balance that she distributed in the year that she distributed it. However, if Elizabeth executes this NUA transaction that we're talking about, she'll roll the shares of Apple stock from the 401k plan into a taxable brokerage account. And that $50,000 cost basis of the stock is what's going to be taxed as ordinary income in the year that she executes this distribution. But the $450,000 difference, that NUA, is not going to be taxed until Elizabeth sells the stock in the taxable account. And when she sells it, the NUA is going to be subject to long-term capital gains tax, which could be as low as 0%, depending on what other income she has for the rest of that year. But if she has marginal income, it's still only going to be taxed at 15%. And if she has a significant amount of income, it's only going to be taxed at 20%. That's the top end today for long-term capital gains tax rates. So depending on what her taxable income is, depending on what her life situation is at that moment, let's say maybe she retired, but she's not eligible to receive Social Security yet, and she's not going to have a pension. So she has almost no other income. That's a great time to be selling those shares and paying next to nothing on that long-term appreciation that she's received in those shares while they were sitting in her 401k account. So I mentioned also that there's a estate planning tactic that comes in here. So beyond the short to intermediate term advantages of opting to pay those taxes on the NUA today, there's also the estate planning advantage that, at the time of this video, of course, right? I want to throw that caveat out there again because tax policy is always subject to change. But if the stock in your brokerage account is left to an heir instead of being sold during your lifetime, that heir is going to receive a step up in cost basis and avoid paying capital gains taxes on those appreciated shares from the point at which you acquired them, right? So if you were to pass away and leave those shares to your heir today, and $500,000 is the value of that account holding the Apple stock, your heir's new basis is going to be $500,000. And that's where they then begin to determine what their relationship is going to be with the IRS as it relates to those shares, right? Also, if you were to pass away while still holding employer stock in your 401k plan, important to make sure that your named beneficiary knows that they would be eligible to request a lump sum distribution and apply that same NUA tax treatment to any portion held in the former company stock. In that instance, your beneficiary is not going to receive a step up in basis. However, they do still receive that same favorable tax treatment as if you had taken the distribution yourself. So there is still some benefit, even from an estate planning perspective, to at least considering this NUA transaction if you're the inheritor of an account that owns a pretty substantial amount of company stock inside of that account. It is important to note that, the tax preferred treatment doesn't apply to any further appreciation in the stock after you've inherited that 401k account, but it's still worth considering because that is a much more favorable tax treatment than where you would inherit that IRA without the stock in it and pay ordinary income taxes on it no matter what. One last thing to point out, also important to make sure that folks are aware that owning a company stock inside that 401k plan certainly has its advantages and also poses some substantial risks, right? People who become too confident in the company's growth potential and maybe rack up too much of that stock put themselves at risk, similar to folks who worked for Enron or Lehman Brothers places like that have become cautionary tales over time. So not a lot of attention gets paid to the risks of owning concentrated stock. And so I just thought maybe it's important to point that out here to anybody who's entertaining this idea or who has already accumulated that substantial amount of company stock inside of the 401k plan. So that's it for today. Hopefully you like this one enough to click on the like or the subscribe button or whatever you're supposed to do in here. But more importantly, I hope you like this one enough to share it with someone else who might find it valuable. Also, I hope that you'll sign up for the Malcolm on Money newsletter so that each week you'll get additional content like this directly to your inbox. And if you have any questions, comments, concerns you want to send in, feel free to do so at hello@malcolmetheridge.com. Thanks for watching.